Welcome to today's video. Before beginning, please read the trade disclaimer. Please understand that this is not financial advice, just my commentary and opinion. Hello everyone. So in this video, I'm going to be going through what a double top is. A double top is effectively a bearish pattern. And what we need to understand is formation, where we can potentially take an entry, where we can have our stop losses, and where our profit targets will be. So ideally, what we want to do is take our entry on the breakout of 0.4, which is the lower line. Okay. Now, a double top is effectively like a rectangular pattern. Okay. And so effectively what we're saying is price moves up, retraces down, and then pushes up and creates the same high as 0.1. So 0.1 and 3 will have almost the same high levels. And then we would expect that as we get towards 0.4, we'll potentially break out on the lower side and ideally, test the lower part, which was originally support of the effective triangle, yeah, and then break down. That's one sort of scenario. The other scenario can be is we break down and only reach halfway, maybe, right? And then move along where we don't touch this. Another potential area is price can break back up, but not go further up to potentially take some stops out and then move back, break back down and move up. So we need to consider all these different scenarios when we look at a double top pattern. So in this case, the area that I'd be looking for potential stops will be as follows. So this can be the middle of the range where we're making the 1, 2, 3, 4 pattern, okay? The double top, which can be the center of it. So we could have a potential stop here, giving us a bigger stop, effectively, okay? Now, what I would want to do before actually marking the different stop levels is I want to first work out my profit target. And the way we do this, we take the line tool, we go from the high of 1 down to where we get the first touch at the bottom to 2, so straight top to bottom. We then drag this and place it where we could potentially expect the breakout or the breakdown, okay? And we would target that. So in this case, we have it perfect, okay? So now based on that, we're going to look at possible areas of entry. And for this, we will use the short risk to reward tool. So first, you can have an entry effectively on the breakout of 0.4. And what we can do is if we take this midpoint and say we split this up into divisions, right? Cells. So effectively, you've got 1, 2, 3, and 4. Now for this, there's tools you can use. An example of a tool that you can use can be, say, the fib tool, where you can set everything to 0.5 levels, okay? Or you can use the fib channel level and just use that. So in this case, I'll use the fib tool to show you. So we select the fib tool, we highlight at the top, and we can go to the bottom, okay? So like this, what we've done in this case is we have effectively split this up from 0, 0.25, 0.5, 0.7 to 1. And in this case, we have 1, 2, 3, 4 zones, okay? Now, I could potentially use this as an area where I may want my stop loss to be. So if I'm entering on the breakout of, say, 0.4, I can take this and move this down to 0.25, okay? And my target at this point can be the high end, okay? So what thing that can happen is we can break out. We may not put our order there straight away. We break out. We put a new order on the breakout point, expecting a potential test. If this occurs, it fills our orders and potentially reaches our target. This gives us plenty of space for our stop, giving a nice risk to reward of 3.81 to 1. Now, the problem you can have here is if, for instance, price does not retrace down all the way down to retest the breakout area as support, and it comes over here, you miss your trade. So you have to take that into consideration. The other place you could do is literally put an order at 0.4, and price could effectively, take that from the same level as 2, which would be roughly where you'd preset your short position. Then you can set your stop loss and TP. Price breaks out, retest potentially, back again to your entry, which can be fine. Even at this point, if it went even lower, you still can be within your stop loss, and then price can go down to your target. Okay, and in that case, obviously, it can work out a lot nice in terms of your setup. Now, if we, for example, wish to enter later, where we put our price around here, where effectively price comes down, does not test, pulls back slightly, and then moves down, we can potentially put an order halfway through, okay, and then we can still have a stop loss at the 0.25, and then we'll get a nice risk to reward ratio at this point of roughly 2.28 to 1, which is still a good trade. Okay, the other ways we can then obviously put a stop loss, we can do it further down to 0.5. Keep in mind, in that aspect, the risk to reward will drop considerably. Now, one of the things that this protects you against is, again, if price came back within the channel, went as deep as the 0.25 level, and then broke out. And at this point, what you may do is may have your entry on the breakout. Okay? And that is another way to do it. An aggressive entry, one could easily enter once price bounces back within, so at 0.1, and this ends up becoming aggressive, and then we can target the high, and then what we can do for a stop loss, we can use the same 25% distance, and if you don't know how to calculate that, just tick this box, okay, and then all you then need to do is use minus 0.25, okay, and that will create one at the bottom. So this is, again, you preparing for when we look at, say, the double bottom, that's where you'd use this, or you can use effectively 1.25, and that will create 25% on here. So you then put this to this level, price breaks down, and yes, you'll get a bigger potential reward. That, at this point, what you could do, you can set target, maybe take profit at 0.5 level and move your stop loss to break even. This is slightly riskier, but understand you still use a good stop loss, okay? And in this case, this would be a higher risk to reward, but is a higher risk trade. But understand that your trade size should be equivalent to what you will enter. So effectively, if this was, a $100 trade, and this is an effective 1.7% move depending on the leverage you're using. So if this was crazy high leverage, such as maybe 100x, you're looking at, this has a potential to gain you, 1,342%, right? And the loss is 1.70, so 170%. And what you would do is you would not enter using $100 here, because effectively that trade would be $170 if it came and triggered your stop loss. So as such, we will take our $100 and split that in the percentage. So effectively dividing that by 1.7. And then that would be your trade size that you would use. So in this case, just for, you know, simplicity, yeah, we can call that, say, approximately $40. Okay, because $50 would be 2%, right? So I'm just rounding it, estimate around $40, and that would be $100 roughly trade size. So when price would hit that level, you'd lose $100. That's how you need to work that out. So these are the different scenarios that I'd look at for the double top. Okay, we'll move over to the double bottom. So as the double top is very similar to the double bottom, the same rules will apply. And again, we have price comes down, tests a low, creates a high, not higher than the previous high, potentially comes down, effectively creates the same type of low. So where 3 is, roughly to where 3 and 1 is. We then bounce, break out the 4, test and push up. And again, the height of the target is measured from 1 to 2. And we will take that height, we will put it to where we expect a potential breakout to be. So in this case, we can move it down to that area here, and our target can be up here. And again, the same sort of rules will apply. We can take the fib point, we can put this over here, and in this case, because previously that was 1.125, we will just change this to minus 0.25. So this is if you were going for the riskier trade. Now the difference is, if we are going for, say, a long position, the ideal area you'd want it is from that breakout. Here you'd want the stop, and potentially you would target, the high, okay, which you obtain from 1 to 2, and that's a good area for potential trade. If you felt that you could miss that, as price may not tap the high again, retest it, we can then obviously target this maybe in the middle of here, or essentially again top where we get a little pullback from. Okay, and then you base your risk to reward, your stop on that at this point. You could do it here, but the stop becomes more risky, so I would rather choose the 0.7 in this case. And ideally, I would enter on the breakout on the 0.4. So that's what I would be looking at. The other way you can look at it, the bigger risk to reward, which can be slightly more riskier, where one would move this stop loss to the minus 0.25, and the entry can be on the reverse of 0.3. You could even have it on 0.25 within the double top the double bottom formation. So it all comes down to your risk management and risk tolerance. Okay, so if you did it like this, the advantage you have is if price did come back up and then reversed within this point here and to come back down, you wouldn't enter. Where if it does do this and we get a push up, you have the potential to make an extra, in this sort of case, 5% based on this. This is not always going to be 5%. So it's the same sort of scenario. This would be higher risk, but again, you have the stop. And in this case, it was 7.96 to 1, massive rewards. And here you've got 3.51. Okay, again, it all comes down to your stops. And your trade size must be set up as equivalent. Okay, so I won't go further on for double bottom because it's literally the opposite of a double top. Okay, thank you. So I'll see you in the next video.